got a lot of something very important to tell you. Thing to do with what's going on with Bitcoin. Something is definitely happening. So I put this thing together, and let's get through testing. Yeah, okay, it's working. Let's get moving right away. So Bitcoin basically hit a low yesterday, but it's been back. It went up. It went up. So if you're one of my members, you know what I did about it. But so let me take you through the chart so you could understand what is actually happening here, because Bitcoin has a lot to do with what the institutions are doing. What if I told you that Bitcoin was being pushed down on purpose? That was my feeling all along. I've been talking about institutions being involved and, of course, taking advantage of the little guy. So, we might have something here. So, listen to me. So, it wasn't a random sell-off. It wasn't so much bad news, not by the market doing markets do, but by one single player pressing a button, dumping Bitcoin at exactly 10 o'clock in the morning. And not a small player, every single day. And what if I told you that the day that player got hit with a lawsuit, the very next day, the pattern suddenly stopped and Bitcoin ripped higher instead? This is not a coincidence. This is a signal. And today, let's break it down for you. And before we go any further, if you're watching this and you haven't subscribed, please subscribe or hit the subscribe button and click the little thumbs up, because that does help us support this channel. And if you want to become a member to know exactly what I'm doing, please go right ahead. So, and don't forget to read books. Very important. All right. Let's get into it. So first, I want to make sure you all follow this along, and whether you've been trading for 10 years or you just downloaded your first crypto app yesterday, let me explain exactly what you're looking at in these charts. And basically, you're looking at a candlestick chart, each with little black or candles on the chart represents 1 hour of price action. So if a candle is on the left side of the chart, that is earlier in the day and earlier in the month, and if it's on the right side, then it means it is more recent. And if you don't follow the charts, okay, just listen to me. I'll make it clear. So the left side of the chart shows off the price, and there you could see the numbers, right? You can see the numbers going from bottom up, lower price at the bottom and higher price at the top. So if Bitcoin is trading at $7,000, you will see the candle near that number. Now, the color of each candle matters. A green, whenever it's green, means that the price went up during that hour. And if it's red, it means it went down. Simple as that. When you see a big red candle dropping sharply, that means someone sold a large amount very quickly and the price fell hard. When you see a big green candle shooting up, it's the other way around, obviously. So now, here is the important thing. Look at the orange circles in the first chart. Okay, look at the orange circle in the first that one. Those circles are highlighted specific moments where the price dropped. Each one of those circles marks a moment where Bitcoin fell sharply. And here's what makes this wild. Each one of those moments happen at the same time of the day, 10 in the morning. So when you see a pattern like that, the same thing happening over and over, this is not random, right? Um, Random things do not repeat on a schedule. Schedules mean someone is making a decision, a human decision, a program decision. That is what we call market manipulation, when someone with a lot of money uses their size to move the price in a direction that benefits them. And the far right of the chart, you can see a big green, right? You see the green arrow pointing up? That is the most recent price action, which is yesterday, and it happened the day after the lawsuit. No more orange circles, no more AM dump, just a clean move higher. Now, and again, I took advantage of that, as my members know. So now that you understand what the charts are showing, let me tell you the story behind this. Right? So let's start with the main character in this story, and the main character is Jane Street. Jane Street is one of the largest trading firms in the world. They are what is called a market maker. That means their entire business model is built around trading. They buy and sell huge amount of assets, stock, bonds, option, crypto, and they do it with incredibly sophisticated computer system that can execute thousands of trades per second. I know these guys because some of my students actually tried to get jobs at Jane Street. And Jane Street pays quite a bit of money to interns, and almost $100 an hour. Imagine. And they set them up and everything. So they have plenty of money. They are not some small hedge fund. Jane Street trades hundreds of billions of dollars in volume every year. They are serious, serious players. Now, in a healthy market, firms like Jane Street actually serve an important function. They provide liquidity. This means when you want to buy Bitcoin, there is always someone on the other side willing to sell it to you. Market makers sit in the middle of what happens, right? So that is legitimate side of the business. But here is where it gets interesting. When a firm has that much power and that much size, they also have the ability to move the markets. And when someone starts seeing the same move happening at the same time every day, you have to start asking, are they using their size responsibly, or are they using it to game the market? According to the lawsuit that dropped recently, the answer may be the latter. They're using it to game the market. The claim is that Jane Street was systematically selling Bitcoin at or around 10 in the morning every single day over a period of several months in a way that created artificial downward pressure on the price. Now, this is not me just saying that, right? Somebody actually filed a lawsuit. I want to be careful here. A lawsuit is not a conviction, right? They are allegations. The legal process has to play out, and you could imagine, that they got plenty of lawyers to say the other way around. But the point is, it's happening. The legal process has to play out, but we do not need a court verdict to look at the chart and see a pattern. The chart tells its own story, and that story is compelling. This is what we call the 10 a.m. pattern, the 10 a.m. pattern breakdown. So let's go back to the first chart and really zoom in into what we're seeing. That one, right? The chart covers a period of several weeks. And if you count the orange, no, actually it's the other one, that one. So if you count the orange circles, the moments where Bitcoin got hit hard and dropped sharply, you can count them. 1 through 11, there are more than a dozen of these drops marked on the chart, all pointing to the same approximate time of day. Think about what that means. For a month, if you were a regular person trying to buy Bitcoin, the worst possible time to buy was around 10 in the morning. Your purchase was almost immediately lose value because the price was being pushed down right after you bought. And if you were someone who knew the pattern, someone who knew the dump was coming, you could short Bitcoin right before 10 a.m. Wait for the drop and profit every single day. That is essentially what market manipulation enables. While you're front running, that is illegal. The people who knew this got rich. The people who don't know get hurt. And usually, based on my many discussions that I have with my contacts in the field, which I share with my members, the little guys getting taken advantage of. Now, the tweet we are looking at says that there's a pattern that persisted for a month. Bitcoin, and then on the day after the lawsuit was filed, it stopped. Bitcoin pumped instead of dumped. The green arrow at the right side of the chart shows the price moving higher instead of getting crushed. Right? The green arrow right here on the right. That was yesterday. One of two things happened. Either the lawsuit spooked Jane Street into changing their behavior immediately, or the filing of the lawsuit caused enough attention and scrutiny that whoever was running this strategy decided to back off immediately. Either way, the pattern broke and the market responded. Now, this is where the story gets even more interesting. And honestly, a little bit unsettling. What we're looking at comes from an account called Bull Theory, and they have been correcting some dots that they are worth paying attention. They've been connecting the dots. Look at the dates that they are pointing to, right? This is this chart. May 10th, 2022, you might remember this date. This is when Luna, the cryptocurrency, crashed from a $40 billion market cap to essentially zero in a matter of days. May 2022. The Luna collapse wiped out tens of billions of dollars and caused a wave of bankruptcy across the crypto industry. It was one of the worst events in crypto history. Then we have October 10th, 2025. This is the date of the largest single day liquidation that we've seen. And there's something that is worth paying attention to. $19 billion liquidated in 24 hours on October 10th, 2025. Liquidation means people who had borrowed money to trade, what we call leverage, got their positions automatically closed as prices fell. That was last year, right? When that happens on a massive scale, it creates a cascading effect where the selling triggers more selling, which triggers more selling. And then the end dumps every day for a month. And then you also have that dump, right? So the argument being made is that all three of these events shares two things. The number 10 as in the date of the time and a possible connection to Jane Street. Now, I want to be transparent. The number of 10 connection is circumstantial, I think, and dates and times of numbers. And if you look hard enough, you can find patterns in anything, right? That gives some skepticism. But the connection to Jane Street, especially around the 10 a.m. setting pattern, that is not a stretch. That is visible on the chart. That is documented, which is the subject of the legal action. And here's what matters for us as people who follow the market. Whether or not Jane Street is in all three events, the existence of any large player using their size to systematically manipulate the market is a problem, and that problem has been getting more attention lately. Look at the second set of charts, right? The Bitcoin weekly price chart, meaning each candle represents a full week of trading. That one. The big drop circled means something. So, it meaning that each candle represents a full week of trading, and the big drop circled on the right correspond to the lunar crash in 2022. In both cases, you can see the price fell sharply and took months to recover. I mean, see on the right and the left, these are not small blips. These are catastrophic events that erase wealth from millions of retail investors, regular people who had no idea what was happening behind the scenes. So let's talk about what is happening right now in the market and why all of this connects. Bitcoin has been in an upward move recently. As I'm speaking to you now, I mean, it was up 68,000. It's down to 66 again, but it was up very up a lot yesterday. And a lot of people have been asking why. The macro environment has been choppy. There's a lot of uncertainty in traditional markets, and yet Bitcoin kept climbing yesterday. Part of this structural, but also Bitcoin ETFs have been bringing in massive institutional capital. Morgan Stanley recently announced that they will get into the Bitcoin game as well. By creating an ETF, more money is flowing into Bitcoin than ever before through regulated products. And when a large amount of money comes into ETFs, Bitcoin has to go up. That is just supply and demand. But there is something that does not take into account enough. When a manipulative force is removed, that's a problem. Give me a second. It kept moving back and forth and confusing. Um, okay, so yeah, so this is structural, right? So Bitcoin has been going up. Thanks. That is just supply and demand. But there is something that obviously the manipulation of it is a problem. So for months, there was a weight pressing down at Bitcoin price every day at 10 in the morning. That is like trying to run a race with someone holding down your shirt, and it was still moving, but slower than you would be. So if that person lets go, you accelerate, right? That's what we're seeing right now. Let's see if it continues. If the 10 a.m. selling pressure genuinely stopped, whether because of the lawsuit, because of increased scrutiny, because of purely coincidence, or because the strategy is no longer viable, then Bitcoin's natural upward momentum can express itself more freely. I'm not saying that the lawsuit alone is responsible for Bitcoin price move. That would be oversimplifying, but it is a factor. The removal of a consistent headwind is always a tailwind. And there is the technical picture. When you look at the daily price chart, Bitcoin is trading above key resistance level and has struggled there for weeks, which is around 66, 67,000. Volume is healthy. The pattern of lower highs and lower lows that we saw during the manipulation period has been broken. Maybe we are seeing higher highs. Let's see if that happens. For anyone watching price action, this is significant. It suggests that at least in the short term, the bias is on the upside. We shall see if it continues. So, Black Swan event. I mean, I mentioned the Black Swan book, but I want to come back now because it's generally relevant to everything we talked about today. We basically argue that The most important events in history are the ones that were unexpected, the one that nobody saw coming. I mean, that seemed impossible before, and that completely changed everything thereafter. Talking about, uh, for example, the start of World War One with the assassination of the um, this guy, the architect of I forget the name, but we think, oh, that's what started World War One. Maybe, right? Coincidental, but maybe. So these are black swan events. You should read that book. It's very interesting. The lawsuit against Jane Street is a black swan in the crypto market. A major institution, one of the most powerful, being directly accused of manipulating Bitcoin. That is not something most people thought would happen. Not like this, not that publicly, not so specifically. And if the allegations are proven, I mean, it's going to take a while, I could imagine. Imagine the lawyer that they must have on this thing, or even if just the attention they create forces behavioral change among large players, then the after effect of the lawsuits will reshape how Bitcoin trades, perhaps permanently. This is the kind of thing that the book referenced, the unexpected event that looks obvious in insight, but that nobody was prepared for. So, in conclusion, let's bring it home. Let's bring it home. So for a month, Bitcoin was being sold at 10 in the morning on a consistent, repeatable schedule. That pattern is visible on the chart, multiple data points, multiple orange circles, as you could see right now. Then Jade Street got hit with an insider trading and market manipulation lawsuit the very next day. And then the 10 a.m. dump did not happen. Bitcoin went up. We also connected this to other macro events in the past, the lunar crash of May 2022 and October 2025 liquidation cascade, that some research linking to the same entity. And we looked at why Bitcoin is moving higher right now, a combination of structural ETF inflows and the possible removal of consistent source of selling pressure. Of course, need to mention that the Clarity Act is coming through. That's going to help compliance issue having to do with crypto, making it more, and Bitcoin, making it more of a tradable instrument, and hopefully adding more security to this market. So let me leave you with this. The crypto market is still young. It is still being shaped by the people who enter it. When institutions come in, they bring both capital and complexity. Sometimes that is good, but sometimes it means regular investors are playing a game that they do not fully understand against players who have massive advantages. So that is a reason why you want to stay informed. You need to watch the patterns. You have to ask questions and never stop learning. Don't forget. That is very important to do going forward. What about Trump first March 1st deadline? Deadline with the tariffs, I'm assuming. Or was it the Iran thing? Dragon East. Tell me what you mean by the March Trump deadline. Glad to answer, but to make sure we're talking about the same animal, same situation. Oh, the crypto market structured. Oh, you're talking. Oh, that's what the Clarity Act. Yeah, he's got to March 1st, but I don't think it's happening. I think it's being delayed a little bit. That certainly would help a lot. Um, that would certainly help a lot. I think they're looking at it. They're looking at it for end of March. They need clarity. Obviously, that's the issue that they're having right now. They can't get the clarity. Okay, this one. But things are coming into place, and when I see all these people getting together, the price is down obviously today because people are taking some. But that could be an interesting coincidence, I have to say. But that's coming through, and obviously it has to happen before November because who knows if they'll be able to do anything if they can't get it passed in time. So let's take a look at this slide, and this has to do with my favorite topic, gold. I know it's all about gold and crypto right now, but this is where the action is. Well, it's about gold, crypto, and is the market overvalued? Frankly, at the end of the day, this is kind of where we're doing. Look at this chart on gold. This is a new chart that is very important right now because it deals with the entire commodities market, and a lot of people are looking at it, but 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 not enough. It's basically gold versus commodities. It's kind of stunning if you look at it. But before we start, let's make sure we actually read this chart because you don't know if you don't know how to read it, none of the rest will make sense. So what are we looking at? You're looking at what is called a dual axis line chart. Okay, and that sounds complicated, but it really is not. Basically, what we're saying is you've got two lines. One is the gold colored line. That's actual gold and the price of gold. The second line is black, and that's what's called an equal weighted commodity index. Now, what is an equal weighted commodity index? Think of it like a team sport, right? You've got a whole bunch of different commodities, and we're talking about oil, natural gas, wheat, corn, um, copper, whatever, lumber. Basically, the raw materials that the world runs on, right? So it's an equal weighted index. Just take all of those commodities and gives each one the same importance. Nobody gets extra credit, right? It's a level playing field, unlike the S&P 500. So the black line is basically telling you how are all commodities doing on average. And the gold line is telling you how is gold specifically doing. Now, here's the important part about reading the dual axis chart. See how the numbers on the left side, you know, go up to 2000, and the number on the right side, only go up to 1,000. And that's because gold and commodities index are measured in different scales. Gold uses the left axis and the commodity use the right axis. And why do it this way? Because if they use the same scale, one line might look totally flat because the other one is so much bigger. By giving each line its own scale, you can actually see how each one is moving over time. So when you look at this chart, don't focus too much on the price, actual price numbers. Focus on the direction and the shape because they're all starting at the same dot, right? Don't look for $5,000 an ounce, basically. And this is where the story is. And this is what the story is telling you. If you start the left side of the chart, which represent the early 2000, um, both lines are quite are sitting pretty low and pretty close together. And gold and commodities are basically moving like twins. When gold goes up, commodities go up. When gold dips, commodity dips. Right, best friend ever. Um, but that makes sense, right? Think about what drives both of them. When the economy is growing fast, you need more raw materials, more oil, more copper, more grain, and at the same time, if there's inflation worry in the air, people buy gold as protection. So they tend to rise together. Now, as we move towards the middle of the chart, roughly what looks it's around 2000 2010, both lines are climbing together. There's a big run up, then a pullback, then another run up. Gold and commodities are still pretty much in line. Like the two runners, train together their whole lives and always finish with a few seconds of each other. So nothing fancy there. But this co-movement is actually important because it's what investors use to build portfolios. If gold and commodities are moving together, they're basically telling the same story. Commodity demand is strong and inflation is a concern. Right? The stronger the economy is, the more inflation you have, and therefore I need to protect myself against inflation. That's why I need the gold. And of course, the dollar might be weakening, which has been the case. But then something changes. And this is where the chart really gets interesting. Look at the right of the chart, the most recent data. The black line, the commodity index, it is kind of flattening out. It's not collapsing, but it's definitely not going anywhere dramatically either. And it's just kind of treading water. But the gold line, it takes off. The rocket, it shoots up in a way that is honestly hard to ignore. It's what traders call a divergence. Two things that used to move together suddenly stop moving together. The question you have to ask yourself is why? Why is gold doing something completely different from the rest of the commodity world? So let's give it a few possible explanations and then let me give you my honest take as what I think this really means. So explanation number one, gold is a safe haven asset. Unlike oil or copper or wheat, gold doesn't really have a big industrial base. Most gold gets bought because people are scared and they're scared of inflation. They're scared of currency problem, that the dollar is not going to be the reserve currency anymore. They're scared of war. Look what's happening in Iran, potentially. They're scared of a financial system that might be shaking at the foundations. So when fear goes up, gold goes up. Plain and simple. Explanation number two, central banks are buying gold at record levels. That is happening. This is a fact. Countries like China, Russia, India, Turkey, they've been quietly, steadily, sometimes not so quietly, buying enormous amount of gold for their reserves. They are reducing the dependence on the US dollar. And when the biggest buyers in the world decide they want more of something, the price tends to go up. Explanation number three, the global economy is in a weird spot. Think about it. You've got commodity prices that should be higher if the economy were truly booming, but they're not really booming. Demand from China, historically the world's biggest commodity buyer, has been slowing. Europe has been struggling, so actual physical commodity demand is soft. But gold doesn't care about industrial demand. Gold cares about fear, and fear is very much not soft right now. So, what is the connection with the black swan? Well, it's key for you to understand that this chart might what really be saying. And the black swan event actually is an event that almost nobody saw coming. Has a massive impact on the world, right? So now, 2008 financial crisis, for example. So that's why I bring this up in the context of this chart, because gold has historically been one of the few assets that sniffs out problem before they become obvious. It's like a canary in a coal mine. When gold starts running hard, and especially when it starts running harder than everyone else, then that often is a signal that smart money is hedging against something bad. And this chart is showing you exactly that scenario. Gold breaking away from the pack, the commodities pack, they're staying flat. That gap between the two lines is getting wider and wider. Is gold actually predicting a black swan event? I'm not going to sit there and tell you that's what the fact. Nobody knows, but because that's literally the definition of a black swan. You don't see it coming. But honestly, whether you believe in black swan is coming out or not, gold's behavior on this chart should, at the minimum, make you ask, am I positioned correctly? Do I have enough protection in my portfolio for a world that might get very messy? Because I know some of you are watching this and thinking, okay, great. So what do I do with this information? Well, first of all, if you own gold or gold related asset right now, this chart is saying you thesis has been playing out. You've been right. Whether or not, nobody can tell you about certainty, but so far people who bet on gold have been winning. It was a bit bleep recently, but we're still back above 5,000. So second, if you own broad commodity exposure, like an ETF that tracks commodity prices generally, you might be wondering why you're not seeing the same gain as gold. And this chart is your answer. The commodity index is lagging gold badly right now. That's not necessarily a reason to sell commodities, but it is a reason to understand the difference between gold and other commodities. Now, of course, if you don't care about any of this and you don't have gold or commodities and you may be sitting on cash and stocks, this chart is the minimum reason to ask yourself, what does my portfolio look like if there's a major shock in the system? If there's a currency crisis, a geopolitical escalation, a financial panic, how does my portfolio behave? Golds tend to do well in these scenarios because what's going to happen with a retail account, when there's going to be a problem, you're going to be selling. And that's usually what happens and makes things worse. I'm not telling you to put all your money in gold. That would be reckless, but I do think that looking at this chart and just shrugging it off would be a mistake. When the market's leading safe haven asset starts moving like this, it is worth paying attention when it's taken away from the other commodity names. Has this happened before? Right? Let's zoom out and bring it whether this kind of divergence has happened before. It has happened, but rarely. There are few periods in modern financial history where gold basically ran hard and left commodities behind. One was the late 1970s, the early 80s, when the US had massive inflation. Again, that word is coming back. Don't tell me I did not tell you about inflation. There was a dollar crisis and a huge geopolitical tension with the Cold War. Gold absolutely soared during that era. Another period was the 2008 2011. Not just saying gold going up, but gold pulling away from the other commodities. After the financial crisis, commodities eventually recovered, but gold kept running harder and harder. It was pricing in years of money printing, low interest, and slow rebuilding of confidence in the financial system. Both of those historical periods had something in common. There were times when trust in the system, government, central bank, paper money was under serious strain, and the market expressed that mistrust through gold. Does this sound familiar? Because here in the mid 2020s, we got a government debt, 37 trillion. We got central banks are printing enormous amount of money. We've got geopolitical tension at level we haven't seen in decades. You know, can you say Venezuela? Can you say Iran? Can you say Greenland? We've got people genuinely asking questions about whether the dollar will remain the world's reserve currency forever. If you look at like my my members every day, I tell them about the dollar index, you will understand. This chart is reflecting all of that. Gold is the market's way of saying we are nervous. And when the market gets nervous about the big stuff, the structural stuff doesn't go away in a quarter or two. So keep that in mind. What do you think about holding gold miners instead of gold? Holding gold. First of all, I mean, I think there are the few ETFs, CM64, the few ETFs that actually, or some silver ETF actually, where it's actually the silver and the gold bullion themselves. So you don't hold on physically yourself, because I mean, holding gold, it's a bit tough, right? Where are you going to hold it? Where are you going to put it? In your house, in a safe? Now and I will tell you, looking at silver, especially, in fact, I looked at it today. If you look at the silver ETFs that hold silver versus that hold the miners, they tend to do better. So there is a difference between holding the the metal itself versus holding the paper, the people that are actually digging for it. So there's paper gold and actual gold. So they tend to do better. Let's put it this way: the commodity itself, especially with what's happening right now. Okay, we'll take a break and then we'll be